Hello there, I'm Chad, and welcome back to your Banking and Credit Toolkit. In the last episode, we talked about what bank accounts are used for and how they work and how an ATM card is a great tool. On today's episode, we'll dive a little deeper into banks and talk about checking accounts, how they work, and why they are a great idea. So let's get started. As we said in the previous episode, banks, savings and loans, and credit unions all have checking accounts, as well as offer savings accounts for individual people and businesses. People get their paychecks sometimes directly deposited into their checking account from their employer, while others get their checks handed to them or mailed to them, and then they put them in their checking account. When you sign up for a checking account, then deposit money into it, you get a checkbook and an ATM card, as we mentioned before. When using a checkbook, it's important to remember that you will need to write down every deposit you make and every check you write, or any money you spend or withdraw using your card. This lets you know exactly how much money you have all the time in your accounts. And some, especially young people like yourselves, have joint accounts where a parent is also on the checking account. Nowadays, people have the ability to use their smartphone and take a picture of their check, and that sends it to their checking account. That is called a mobile deposit, and it saves a lot of time. It's another good tool for you to use. As long as you have money in your account and do not write checks, use your card, or take out more than the amount of money in your account, you will not get what is called an overdraft fee. Do you know what an overdraft fee is? Well, this is a preset amount of money that a bank charges someone who draws more money out than they have in their account. When you have $500 in your account and write checks for $600, you will be overdrawn or in the negative by $100. When your account goes negative, you will often be charged an overdraft fee, and sometimes these overdraft fees can be quite a lot, sometimes $20 to $35. And on top of that, more fees are added over time, like every 3 days or so, until the amount owed to the bank has been paid back. This includes the original amount that is owed and also the overdraft fees that must be paid back in full. So, the best way to not have overdraft fees is to always balance your checkbook. Make sure you have a buffer of $100 so you don't fall into the negative. Balancing a checkbook is easy but important. You must always know how much money you have in your checking account, know how much you can spend, how much you have spent, and also include what you wrote a check or used your debit card for, what business or person got that check or debit payment, so that you will always have a record of expenses. Banks give you a payment ledger so you can track the checks you have written and the amount you have left. These ledgers are another really good tool to use. This is also very important if you have a business, so that you can see what you paid for, such as supplies or even professional services, such as an accountant who does your taxes for you. They look at things you spent money on to see which payments may be tax deductible. That means the government gives you a tax deduction for things that you spent money on that are important for running your business. You add up all the deductions before you calculate how much profit you have. The government only taxes you on business profits, so deductions are another really good tool to use to minimize your taxes. Okay, now you know how a checking account works, along with using checks and ATMs and using the payment ledger to keep track of the money you have left to spend. Now you'll be ready when it's time for you to have a checking account. In the next episode, we'll learn how savings accounts work, why they are used, and why they are important. Thanks so much for watching. I'll see you soon.